The reason the big tech seven are called giants is because of their massive market cap. They have trillions in value. Currently, the top three are Nvidia, Microsoft, and Apple. Nvidia and Microsoft are both valued around $3.5 trillion, and Apple's market cap is about $3 trillion. The big question is who will be the first to break the $4 trillion mark. This is a key focus because a company that breaks $4 trillion will likely take the top spot among the giants. All these tech giants are benefiting from AI investment. However, Apple has been lagging behind in advancing AI functionality. It clearly trails in this area. So right now, Nvidia or Microsoft are the most likely to break the market cap barrier first. Although Nvidia's revenue is strong, Microsoft appears to have the edge. Why do I say that? Here's why. In recent years, Nvidia's strong performance has largely come from the explosive growth of its data center businesses. In Q1 this year, data center revenue grew 73%. Large-scale customers like Microsoft are buying Nvidia GPUs at a rapid pace. Nvidia's management has also stated that GPU supply remains very tight. So for the rest of this year, revenue growth should stay strong. But for Nvidia, it relies heavily on a few large customers, including Microsoft. If these companies suddenly cut back on AI spending or switch to other chip suppliers, then Nvidia's revenue could see a noticeable slowdown. That's a real risk for them. And on top of that, Nvidia also faces competition from other GPU makers and even from its big clients who may design their own chips. So even though Nvidia can keep growing fast, this risk can't be ignored. That's a key concern moving forward. Right now, Nvidia stock is trading at around 34 times earnings for a high growth, AI driven, large cap stock. This kind of price to earnings multiple isn't excessive, but if anything goes wrong with its execution, the downside could be significant. If any operational issues come up, the stock could sell off, and the drop could be substantial. As for Microsoft, its performance on the Azure cloud platform lately has been outstanding. Part of this comes from its partnership with OpenAI. Early in 2023, Microsoft invested another $10 billion into its cloud platform, which strengthened Azure and boosted its own enterprise AI capabilities. Although Microsoft is also developing its own AI models, which has created some tension, it has already solidified its leading position in the cloud market, and the market recognizes that. That's why it's also among the tech giants, as the first to hit a new all-time high this year. And according to Microsoft's guidance in fiscal 2024, capital spending is set to hit $80 billion, and most of this money, what is it for? Mainly for building AI data centers. And its revenue growth is picking up speed. In the latest quarter, growth hit 33%. That outpaced its rivals, and a big part of that growth came from AI training and the inference demand that will further drive Azure revenue and boost overall performance. And it's not just Azure. Microsoft's other products are also benefiting from AI. Both enterprise and consumer customers are seeing double-digit growth. Currently, Microsoft stock is about on par with Nvidia's, but Microsoft enterprise software and cloud business portfolio is more diverse and more stable. Plus, both of its core sectors are showing very strong growth with a trend toward profit improvement. So from an investor standpoint, Microsoft is arguably more attractive. Its market cap is more likely to be the first to reach the $4 trillion mark. The market is analyzing and comparing these companies, looking at the top three by market cap. Which one is most likely to break the $4 trillion mark first? The market has offered some analysis, and we found that Microsoft seems to have the highest rating. The outlook for its future is very positive. This is especially true in AI, where Microsoft has clearly taken the lead. Right now, Nvidia and Microsoft have similar market caps, but overall analysis shows Microsoft is most likely to be the first to break the $4 trillion market cap. It's a company most likely to hit that milestone. So the market is very optimistic about its future performance. This is a positive signal. We can keep an eye on its stock price. That's a key indicator to watch. As we analyzed earlier, Microsoft's performance have been quite strong. From a technical standpoint, we can tell that it's currently in an overbought condition. its stock is making new highs. But as you can see, the indicator clearly is starting to turn down. The MACD has formed a bearish crossover and is pointing downward. The momentum for short selling is gradually taking control, but why hasn't stock price dropped? Because the market remains optimistic. So investors are reluctant to sell. Thus, the stock is absorbing buying interest. We can see this from the trading volume. During the rally, the volume hasn't expanded, it's still quite low. So people are unwilling to sell. The market is forced to push the price higher to meet the selling price expectations. Once the price meets their expectations, they will be willing to sell. So the price will continue to rise until it reaches their target and only then will they sell. It will only rise slowly until it meets their selling price. It will continue to climb. If it hasn't reached that price, it will just keep going up. From the current perspective, there's a signal worth noting. What is it? It's that Microsoft had a clear volume spike last Friday. This volume spike is significant compared to recent volume. It's a multiple of the usual volume, so the increase in volume is very noticeable. As we mentioned earlier, if Microsoft experiences a volume spike after price rise, it's something we need to watch. It's not necessarily a good signal. In the short term, it might mean the price has risen enough and some investors feel it's time to sell. That's why the volume increased. So this volume spike at highs isn't a positive signal. If we see a volume spike at high levels, we should be cautious. This could indicate a slowdown in growth and possibly a small adjustment. In the short term, it may stagnate and see a slight correction. So from the intraday chart, we can see that the decline is occurring with increased volume. It's showing a clear overall drop and it's happening with volume at the highs. At the highs, there's a sharp drop and a bearish candle forming. So at this point, the signal is quite clear. It indicates some funds are exiting, they are selling off. This is likely the liquidation phase, so this could trigger a correction. However, the downside isn't expected to be significant. A small adjustment seems likely. The adjustment could be because there's a lot of profit taking from earlier gains. It broke through a key resistance zone, a high volume area. There's bound to see some trapped positions here. So after the breakout, some funds are likely looking to sell. Thus, the volume spike here isn't an ideal signal. We can expect some volatility in the short term as a result. So, what will happen next? Will there be a significant adjustment? This is unlikely to happen. It will only show support around this level. If it breaks through this level, there's clear support here. Breaking through this position can look for support around this level. The market will find support here. So, any pullback is unlikely to be significant. No deep correction. It will pull back to this level. This level will provide support. There's a possibility that even though the market is affected by external factors, it might consolidate at higher levels. This is more likely. Even if there's a significant pullback, there's no need to worry. It's nothing to fear. The market has strong confidence in its performance and its business is very stable, especially in AI. It's very strong. The fundamentals are solid, so it will attract more capital. Even if it adjusts, it will still attract the investors when it reaches a certain value range. This will bring more funds in, so at this point, more capital will flow in. So the downside potential on the current technicals is that it's in an overbought zone. In the short term, the technicals might reach a limit and there's volume expansion, so the signal is clear. A pullback is likely to occur, but this pullback is nothing we need to worry about. The downside will be limited. In fact, a pullback could attract more capital. This could push the stock price up again. It's very likely that its market cap could reach $4 trillion. It's a technology company, so the market has high expectations for it. So why in the tech sector during this rebound has only Microsoft managed to break through its previous resistance and reach new all-time highs? The one closer to this goal is Nvidia. But for Nvidia, although its revenue is strong, there are still certain risks for the company, so the market's assessment of it remains somewhat cautious. There's still some hesitation, still hesitant. So when we look at Microsoft, even if it faces pressure from the broader environment and sees a correction, it's not a major problem. Looking at the shorter time frames, we can clearly see there's an obvious divergence. The MACD indicator shows a clear divergence. The stock price made new highs, but the MACD didn't hit new highs along with it. So technically a pullback is needed, but this correction actually creates an opportunity. You could put it this way, from the 4-hour chart, Microsoft shows technical signs of a pullback, a need for a correction, a retest, but this could be a buying opportunity. Once it pulls back and finds support, because this area previously offered support, there is support here. Specifically, which level? Probably right around this area, near 458, around 458, it should find support. That could fix the technicals. Then the trend is very likely to turn up again. The odds are high. It's very stable, judging from the price action. It's just recently not only have technical factors appeared, but the market environment also isn't favorable for a sharp rally right now. On the news front, there's a lot of negative news, plus its own. If you look at the Nasdaq or S&P 500, their trends are also showing clear signs of weakness, weak signals. So technically, the market needs a technical correction. For another rally to happen, the technicals need to improve first, especially for technical traders. It's hard for them to find good entry points, so technically we need to see a better signal. The current signals are weak. This affects those investors who rely on technical analysis. Their decisions because the technical picture isn't ideal. With the trend already weakening, it's harder for the market to move. So, in the short term, the market needs a technical recovery. Plus, there aren't any strong positive catalyst in the news. So, if the market wants to break out again, there isn't enough momentum. The drive is lacking. There's not much follow through, so we expect the market to recover first. The recovery doesn't have to mean, for example, that the Nasdaq or S&P 500 will see a sharp correction. That's also unlikely in the short term. In the near term, the market may consolidate in this range, then build momentum to move higher. That's our outlook going forward. If you have any questions or other opinions, feel free to leave a comment below.